Hi, everyone. Welcome. I'm Kiersten Landers, and today we're talking about credit repair and the strategies that actually move people from not qualified to owning a home. This is co branded with my partner in crime, the amazing Anike Wilder from the Anderson Hicks Group. Let's jump in. For those who don't know me, I'm a mortgage broker here in Eastern Idaho. I work with almost 50 lenders, so I'm able to match people with the right loan instead of pushing everyone into the same box like a retail lender or a credit union lender. I specialize in helping buyers get mortgage ready, even if they're starting from scratch. I don't just do tricky loans, I advise. I map out a strategy, I educate, I help people save money, real money. In fact, according to 2023 Home Mortgage Disclosure Act data, borrowers save an average of at least $10,000 over the life of their loan when they work with a broker like me. And one of the reasons I love teaming up with Annika is that we both believe people aren't unqualified. They're just not qualified yet. We actually worked with a buyer for over a year, step by step, fixing her credit and restructuring her debts, and she bought. So everything I'm going over today is based on real results for real clients. Now, let me brag about Annika for a second. She's one of the top agents at the Anderson Hicks Group with Keller Williams. She cares deeply about her clients, and she's honestly one of the most creative problem solvers I've ever worked with. Fun fact, she actually started in marketing at Anderson Hicks and was the brain behind their huge community scavenger hunt. Leadership saw how incredible she was with people, how solutions oriented she is, and basically said, okay, you belong in real estate. And they were right. Annika is the kind of agent who rolls up her sleeves and works with the long game clients, which is why we work so well together. Okay, so why are we talking about credit? Because credit and debt load are two of the biggest barriers to home ownership. And the difference between a 580 score and a 640 score can change your interest rate, your loan options, and how much you qualify for. Today, I'm giving you practical, realistic strategies backed by real data, the kind of steps that actually get people into homes, not just make them feel productive. Everything we're talking about falls into three buckets. The first, credit report accuracy. Because if something wrong is reporting, it drags you down instantly. The second, utilization. That's how much you owe compared to your limit. And the third, payment consistency. Boring but powerful. Let's start with accuracy. You get one free credit report per bureau per year. Use it. Consumer Reports found that 34% of Americans have at least one material error on their report. If you see something wrong, pull all three reports, find the issue, and dispute it with documentation. Errors get removed more often than people think, and sometimes that alone boosts your score. Payment behavior makes up 35% of your FICO score. Nothing moves the needle like paying on time. So, what do? Set up auto pay, and if possible, make bi weekly payments so the balances reporting to the Bureau stay lower. And if you have anything past due, like collections, late payments, tackle it. That's the first layer of cleanup. Utilization is simply your balance divided by your limit. This is about 30% of your score. Credit scores improve under 30% utilization. The best scores often sit under 10%. Experian found that people with 800 plus credit scores have an average utilization of just over 7%. So, what does this tell you? It tells you credit utilization matters. To lower utilization, you've got options. You can pay down balances before the statement closes. That means paying it by the statement date, not by the due date. You can also request a credit limit increase, and you can avoid closing old cards. You can even redistribute balances across cards. These are small tweaks with big impact. Adding an authorized user can be a game changer. If someone with good credit adds you to their card and they keep great habits, their history can help your score. This is fantastic for young buyers or anyone rebuilding. Just make sure the primary cardholder is responsible or you inherit their bad habits too. Credit repair is consistency, not perfection. Sometimes that means canceling subscriptions you forgot you had, selling a few things around the house, picking up extra hours, asking for a merit raise, or entering a temporary beans and rice season so you can throw money at your debts. Every small step compounds. That's how people win. Now, let's talk about debt to income or DTI. For those who aren't familiar, DTI is a simple but powerful measure lenders use to see how much of your income is going towards monthly debt obligations. It's calculated by taking all of your recurring monthly debts, like credit cards, car loans, student loans, and housing payments, and dividing that by your gross monthly income. So, if you make $5,000 a month and your debts total to $2,000, your DTI is 40%. DTI is important because it tells lenders whether you have enough income to comfortably handle a mortgage in addition to your existing obligations. Even if your credit looks great, a high DTI can limit the loans you qualify for or increase your interest rate. And I have to tell you, I've seen this again and again. I've had people apply who have great credit scores, but their DTI is simply too high to qualify. So, this is an important slide. Conventional loans prefer 45% or lower, but will go up to 50 with compensating factors. FHA likes 43%, but we see approvals above 50 with automated underwriting. VA technically doesn't have a max. 41% is the benchmark, but they'll go higher if residual income is strong. And USDA likes 29% for housing and 41% total. The takeaway: if we improve your credit and lower your monthly debts, we open up a bigger box of loan options. Let me show you how fast things can turn. Here is a scenario showing you how easy the mechanics are to fix your credit utilization and therefore improving your debt to income ratio. Say you have a $10,000 credit limit and a $6,000 balance. That's 60% utilization. You double up payments for a few months. Maybe your credit card company increases your limit. Maybe you stop eating out for a bit, and maybe someone adds you as an authorized user. Suddenly, after a few months, you're at 15% utilization. Your score jumps, your DTI improves, and now you may qualify for programs you didn't before. When we're getting someone ready to buy, we're looking at 5 things: credit score, utilization, payment history, DTI, and stable income or funds to close. Once we get these things aligned, even if it does take time, the approval follows. Okay, so that's it. Thank you so much for being here. Credit repair is absolutely doable, and homeownership is often closer than people realize. This webinar was actually Anike's idea because she wanted to provide her clients with real practical strategies to get mortgage ready. And I'm so glad we can make it happen together. If you want help, I have access to almost 50 lending banks, niche programs, conforming loans, government loans, chattel loans, lot loans, HELOCs, refinance, you name it. I'm not just a loan officer, I'm your advocate, I'm your strategist, your partner in this process. And partnering with Annika means you also have a realtor who will go the extra mile to make your buying experience smooth and successful. So scan this QR code to gain access to Annika's profile on the Anderson Hicks website. There you will find her contact information and links to social media and her email. She can also be reached at 208 423 1775. Lastly, you can scan this QR code to gain access to my website, landerslending.com. There you will find my contact information, resources, and a link to the application when you are ready to get started. Feel free to email me at kirsten@empirehomeloans.com or call me at 208 270 3861. Annika and I are here and ready when you are. Don't hesitate to reach out to either one of us.